For decades, the world has funded the US, and treasuries have been the safest place to park cash. But what if that changed, and the world started dumping them? As of early 2026, the US national debt has skyrocketed to over $38 trillion, and about 24% of it is owned by foreigners, mostly by governments. That means the US isn't just borrowing from investors, it is borrowing from foreign powers. And if they ever decided to sell that debt fast enough, the shockwave would hit everything. The top holders read like a list of global powers. Japan alone holds over $1 trillion, China holds hundreds of billions, and Europe collectively may control trillions more. That is leverage, the kind that can break markets. But this isn't just money that America owes, it is the foundation of the entire global financial system. Think of treasury bonds as IOUs issued by the US government. When the government needs money to fund its operations, it doesn't just print cash. Instead, it borrows money by selling treasury securities. Short-term treasury bills under a year, medium-term treasury notes 2 to 10 years, and long-term treasury bonds 20 to 30 years. Treasuries don't just fund America, they set the price of money for the whole planet. So if treasuries get dumped, borrowing money gets more expensive for everyone. Imagine Japan has $1 billion from trade surpluses from something as simple as selling more cars and electronics to America than it buys. Japan now has a pile of US dollars sitting around. So what does it do with that money? It buys a 10-year treasury bond paying, say, 4% a year. Every 6 months it gets an interest check, but after 10 years it gets the original $1 billion back plus everything it earned. And that's why treasuries are seen as the safest investment on the earth. Even when the world is falling apart, the assumption is America will still pay. The US has never defaulted, and with roughly an eighth of the world's total GDP, it's a streak investors expect to hold. For America, treasury securities are how the government funds itself without raising taxes or cutting spending. The US runs a persistent budget deficit, meaning it spends more than it collects in taxes every single year. That gap is filled in by borrowing, primarily through selling treasury securities. In the fiscal year 2024, the federal government spent roughly $6.8 trillion but only collected about $4.9 trillion in revenue. That $1.9 trillion difference was in borrowed money, much of it from foreign countries. For other countries, the US treasuries serve multiple critical functions. First, they're a safe place to invest foreign exchange reserves. Countries need reserves to stabilize their currencies, pay for imports in emergencies, or intervene in currency markets. Second, treasuries can help countries manage their currencies. If China wants to keep the yuan from rising too much, it can buy US dollars and treasuries, boosting demand for dollars and easing demand for yuan. Third, treasuries act as global banking collateral. Banks use them to secure short-term funding, support international trade, and meet capital requirements. And that's why a sell-off wouldn't stay contained. It would spread into everything those reserves support. But the global significance goes even deeper than that. US treasuries effectively set the risk-free rate of return for the entire planet. Pretty much every other interest rate, corporate bonds, mortgages, car loans, even credit cards, gets priced as a markup on treasuries. If the 10-year pays 4%, a company might borrow at 6%, and a risky startup might pay 10%. Either way, it all anchors back to the treasury rate. However, more and more countries are starting to dump their US debt holdings, and there are a few reasons for this. The United States Treasury securities are a fantastic way to quickly generate large amounts of US dollars and short-term capital. This becomes useful if experts believe the value of the dollar will drop in the near future, or if a country needs to access a large amount of money very quickly. Selling treasuries is essentially cashing your chips in while they still have value. Second, as relations between countries improve, they tend to buy each other's debt and invest in each other's economies. But when those relationships deteriorate, countries start to cut their exposure to each other's debt, and that is where things get dangerous. 2025 arguably saw one of the most drastic reductions in foreign relations. In 2025, global trust in US stability took a hit, and in bond markets, confidence is everything. Once confidence cracks, money moves. Take Japan, for example. The country with the biggest single US Treasury bond holdings was hit with a 15% tariff on exports to the US during 2025. In May 2025, the Japanese finance minister Katsunobu Kato said Japan's large treasury holdings could serve as a trump card in negotiations, discouraging US moves that might strain US-Japan trade and broader relations. But this was after Japan sold over $220 billion in US Treasury bonds over the course of the previous 3 years, with $20 billion sold in April 2025. This pushed yields higher across the Treasury market, meaning the US had to offer more interest to investors, partly to keep demand strong and discourage other countries from selling off their own holdings. And this is where the chain reaction begins. China, the second biggest owner, also experienced significant damage to its relationship with the US during this time. Combined with China's rapidly growing economy, this resulted in China selling massive amounts of debt. Tariffs imposed by both countries and additional hostile economic moves have led to China preventing the US from accessing some of its vital ore and metal products. China has also taken steps to reduce its reliance on the dollar while trying to strengthen the yuan's global position. By selling US debt, it can put pressure on the dollar, and if it uses the proceeds to buy yuan, that can support its value at the same time. Perhaps the most alarming recent development comes from Europe. Washington has recently floated the idea of acquiring Greenland from Denmark. They argue that its location near North America makes it strategically valuable to the US. But France has been ahead of the pack, creating an anti-coercion package, which includes the potential for reducing investments in US Treasury bonds and other holdings. And the leverage that European nations hold is substantial. By some accounts, the EU and UK together control roughly $2.5 trillion in US Treasuries. That is double what Japan has and 3 times more than China's holdings. And that is the thing. They don't have to sell everything, they just have to sell enough. But what would actually happen if countries decided to dump their US Treasury holdings? Let's walk through several hypothetical scenarios, starting with the most immediate effects and then spiraling outward to the global consequences. Let's say China tried to liquidate its entire Treasury portfolio in a single trading session. Dumping that much debt at once would flood the bond market with supply. And when supply overwhelms demand, prices drop fast, meaning bond prices would plunge. This is where things get technical but critical. When bond prices fall, yields rise. A $1,000 treasury paying $40 a year yields 4%. But if panic selling knocks that bond down to $800, the same $40 becomes 5% yield. Nothing about the bond changed, only the price people were willing to pay for it, which is really what shifts when markets start pricing in more risk. To restore confidence and attract buyers to the collapsing bond market, the US Treasury would be forced to offer significantly higher interest rates on new bonds. The Federal Reserve would also likely be cornered into emergency policy moves to stabilize the economy. Next, mortgage rates would soar because they're priced off the 10-year Treasury. If the US Treasury bonds jump to 6.5% or 7%, mortgages could soar into the double digits. At 10% mortgage rates, home values would fall, wiping out the middle-class wealth and killing consumer confidence. For many Americans, a home is their biggest source of wealth, so a sharp drop in prices wouldn't just hurt their finances, it would hurt their confidence too. Credit card and consumer loan rates would soon follow. Corporate borrowing would dry up as companies face higher interest rates, making expansion plans and new investments unprofitable. This would lead to an artificial full-scale economic tightening. The second scenario turns the bond-stock connection into the main pressure point. If countries rapidly cut their treasury holdings, markets could panic, dragging down major US indices like the Dow, S&P 500, and NASDAQ. At the same time, money would likely flood into traditional safe havens like gold and stable currencies like the Swiss franc. Some investors might also look to alternatives like crypto. This would leave ordinary Americans with 401ks and IRAs in a precarious position, as those systems directly depend on the stock market and the US Treasury bonds. In the worst-case scenario, the US could see its population's retirement accounts and college savings plans wiped out in one fell swoop. When that hits, the country might see a severe political and social backlash, as people would undoubtedly think fault lies at the administration's door. And if that sounds dramatic, remember, markets don't need to fully collapse to terrify people, they just need to drop fast enough. The third scenario hits the banks directly. Since US banks hold trillions of dollars in treasuries on their balance sheets, assets that are supposed to be the safest and most stable. But when yields rise, bond prices fall, and those losses can stack up fast. Silicon Valley Bank's collapse in 2023 was driven in part by unrealized losses on its bond holdings, and that came from a much smaller jump in yields than what we're talking about here. Now imagine that across the entire US banking system. If banks suddenly start to run out of money, they will escalate to the rest of their services as a balancing act. Apart from high mortgage rates, banks could dramatically tighten lending standards, requiring larger down payments and better credit scores. Home transactions would grind to a halt, construction jobs would disappear, and all the industries dependent on housing would suffer catastrophic losses. In a fourth scenario, the value of the dollar would fluctuate greatly, which could have devastating consequences for domestic industries. At first, it could even strengthen as global investors scramble for liquidity. Since so much international debt is dollar-denominated, borrowers may rush to secure dollars to make payments, pushing demand up in the short term. But in the long term, the confidence in the US dollar as the global reserve currency could erode. Countries could accelerate their efforts to diversify away from US dollar reserves. Alternative currencies, digital currencies, and gold-backed settlement systems may become more widely adopted. In particular, the BRICS nations, including Brazil, Russia, India, China, and South Africa, have been working on alternatives to the dollar-denominated system for years. A US Treasury crisis would be seen as their arguments being proven correct, accelerating the trend toward a multipolar currency system. But the fallout could be more than economic. A coordinated Treasury dump could be interpreted as a hostile act. The US could respond by sanctioning foreign banks, particularly those in China, which have already been working to undermine the dollar as the global currency. This would lead to America and China's allies to be forced to take sides, splitting financial alliances and triggering a new Cold War, only this time with balance sheets and central bank reserves. In this scenario, countries that haven't yet pulled the plug on their selling of Treasury bonds become kingmakers. They can decide whether to rake in the increased long-term yields and become a vital US partner to ensure the country's economic future. Of course, there is a very simple concept that keeps all of these scenarios from actually happening, or at least to the point of crippling the world economy: mutually assured financial destruction, or MAFD. Dumping treasuries hurts the seller too. It works a lot like Cold War deterrence, just as the US and Soviet Union avoided nuclear war because both sides would be destroyed. Major treasury holders can't dump US debt without triggering damage that would hit their own economies too. If China liquidates its entire treasuries, it drives down prices on the very thing it's trying to exit. Every bond it sells pushes the prices lower, meaning once the process starts, China actually loses by trying to sell the rest. If China bought a 10-year treasury bond at $1,000 and sells it when the market price has dropped to $800, China just lost $200 per bond. Multiply that by hundreds of billions of dollars in holdings, and you're looking at losses in the hundreds of billions. But there's still another layer here, and it's the most unsettling one. It is the nuclear option, and it's completely legal under US law. The International Emergency Economic Powers Act, or IEEP, gives the president sweeping powers during a national emergency. If foreign governments coordinate a treasury sell-off, the president could declare it a threat to national security. Under IEEP, the Treasury Department could freeze the assets of any central bank participating in the sell-off. Europe can't sell because the US refuses to recognize the transfer. Their trillions would just sit there locked. It would technically constitute a default on US obligations, but American courts defer to the president on national security matters. It's the financial equivalent of seizing an enemy fleet in wartime. But that also means that treasuries aren't truly risk-free. Their safety depends on other countries choosing to not test the system. In the end, the US still relies on major investors being willing to take that risk and keep buying American debt. At this point, there is no simple answer. The global economy is too interconnected to predict even the broad outline of what will happen next. And because markets run on confidence and perceived stability, once that foundation starts to crack, the usual rules don't apply, which is the real danger. For now, it's safe to say that none of these scenarios is likely. Everyone has too much to lose by pressing the sell all button. But the terrifying part is, the button exists. And once confidence breaks, it doesn't take a full sell-off to start a panic. Now go check out What If US Economy Crashes Tomorrow, or click on this video instead.